You'll find the link to Bitcoin white paper summary in the description and pinned in comments below. Most crypto losses don't happen because of backs, hacks or rug pulls. They happen because traders misunderstand four invisible stages that control every market. Miss one and your money evaporates. Stay with me, I'll show you how to spot each stage before it destroys your gains. Four stages, one fatal mistake. In the next few minutes, you will learn how accumulation hides under boring price action, why the markup phase feels like euphoria, how distribution is the quiet exit of smart money, and what decline really looks like. You will also get exact signals you can trade around, real examples and visual rules you can use. Watch to the end. The last insight changes how you will protect every future trade. What you will learn: accumulation, markup, distribution, decline, and one fatal mistake. If you want clear, no nonsense crypto breakdowns that cut through the noise, subscribe now. We release practical videos every week that help beginners trade safer and think like pros. It sounds simple: markets go up and down, but behind every move is a repeatable four-stage cycle. Almost nobody explains them together. Stage 1 is accumulation. Large players quietly buy while retail thinks nothing is happening. Stage 2 is markup. Price accelerates and headlines appear. Fear of missing out grows. Stage 3 is distribution. Insiders sell into the hype, often while retail is still buying. Stage 4 is decline. The price collapses as demand dries up. Think of it like a party. Organizers quietly let guests in, they turn up the music, then they slowly leave while the crowd does not notice. Finally, the lights come on. If you miss these stages, you feel regret, panic, and the worst, helplessness. But accumulation is the stage most beginners completely misunderstand. That misunderstanding costs thousands. Why does a coin sit sideways for months while whales quietly add millions? Because accumulation hides in plain sight. Accumulation is characterized by low volatility, occasional test lows, and stealthy volume increases. Large buyers use small orders, limit buys, and over the counter deals to avoid spiking price. On your chart, it looks boring, a rectangle, but that rectangle holds the future breakout. Think of accumulation like planting seeds in winter. It is ugly and slow, but you do not plant during spring. You plant before growth. Look for higher lows inside a range. Volume spikes on support tests are significant. Price that rejects down moves quickly in a clue. Missing accumulation means you buy later at inflated prices. Nothing feels worse than buying at the top. Once accumulation ends, something weird happens. That market suddenly decides to run. The market suddenly decides to run. That next phase looks like freedom. It is also the start of the most dangerous stage for beginners. The markup phase is when headlines and influencers arrive. It feels unstoppable, and that is exactly the problem. Markup shows as persistent higher highs, increasing momentum and expanding social buzz. Retail enters late, often using leverage. The psychology is greed, confirmation bias, and this time it's different. We will break down signals that tell you whether the markup is healthy or a bubble. During markup, you will see consecutive green candles, rising RSI, and soaring volume. A healthy markup is a steady climb with volume confirmation. A parabolic markup is a steep rise with volume spikes that then fade. Do not buy the first parabolic candle. Consider scaling in instead. Use a trailing stop strategy and set stops by percentage or structure, such as the most recent higher low. Watch for divergence like rising price with falling volume or RSI divergence. During the markup phase, greed is contagious. People convince themselves they miss the train, and that causes the next mistake. Then comes distribution. That is where the party actually ends. Distribution is not chaotic, it is methodical. Big holders sell quietly into the hype. Most newbies never notice the signs. Distribution shows as choppy price action at the highs, big wicks, narrowing range, and volume spikes on both up days and down days. Smart money uses algorithms and OTC desks to offload positions gradually. On charts, watch for failed breakouts, rising selling volume, and lower highs forming. A token can rise tenfold and look healthy on the surface. 4 months into the rally, you may see increasingly large upper wicks and volume clusters. That is distribution in action. The insiders are selling while retail keeps buying the story. Sell signals include higher volume on test days and failed new highs. Watch the order book for persistent sell walls at new highs. If you are holding through distribution, you will feel hope and denial. You will hope the price keeps going and ignore the evidence. Most beginners think declines are sudden. They are not. Decline has hints if you know where to look. Here is the secret most educators do not tell you. Markets often test the distribution zone again before the real crash. That test is when most retail doubles down. Why do they double down? Because they see a second chance. This is the exact mistake that turns a small loss into a total wipeout. If you can recognize this test, you can lock profits and avoid being trapped. Decline looks violent, but it has a structure. If you understand it, you can reduce losses or even profit from it. Decline often begins when demand collapses after distribution. You will see sharp breakdowns below support, increased selling volume, and cascading stop loss triggers. Capitulation is the final phase. Panic selling creates a vacuum that is often followed by a dead cat bounce. Protect capital with stop losses placed under structure, not under noise. Use position sizing and never risk more than a small percentage per trade. Consider hedges such as stablecoins, inverse ETFs, or short positions. Decline produces fear and shame, but it also creates the next accumulation opportunity. If you can stay disciplined, knowing the shape of decline lets you plan entries for the next cycle. There is one final mistake that ruins most beginners. It shows up at the worst time. The fatal mistake is narrative addiction. Narrative addiction is following stories instead of price structure. You trust promises, tweets, or this time it's different storyline. Even after clear distribution signs, narratives keep retail invested. The remedy is to make decisions from structure and risk, not from headlines. Check structure first. Confirm with volume. Ask yourself, would I buy if no news existed? Breaking a narrative is hard. It feels like losing hope, but it saves capital. Now I will give you a simple playbook that ties all four stages together. Use it on every trade. Here is the playbook you can use immediately. Step 1. Identify accumulation. Draw ranges, mark higher lows, and note volume clusters. Step 2. Confirm markup. Look for rising structure, volume confirmation, and momentum checks. Step 3. Watch distribution. Look for failed breakouts, increased sell volume, and upper wicks. Step 4. Protect during decline. Place stops, reduce size, and hedge when necessary. Step 5. Follow exit rules, scale out on markup, and fully reevaluate at distribution. Do not hold through capitulation without a plan. An example walkthrough helps make this real. Imagine you identify an accumulation range and mark clear higher lows. You enter a scaled position as the markup begins with a small initial size. As the price moves higher, you add to the position using a predetermined scale plan. You place trailing stop under the most recent structure and adjust it as new higher lows form. During distribution, you begin scaling out and locking profits on rallies with large upper wicks. You keep some exposure for optionality, but you have clear stop rules. If the price breaks down and selling volume spikes, you reduce size further or hedge. Follow this playbook and you trade with the market, not against it. That is the difference between surviving and thriving. Here is the one mistake that ruins more accounts than leverage alone: the belief that narratives are more important than structure. When you trade based on storylines, you are always one viral tweet away from loss. Structure ignores headlines and focuses on supply and demand. Use structure to guide entries, exits, and risk. If you found this useful, subscribe now. We break down real market structures every week so you do not learn the hard way. Join the community and make smarter decisions, not emotional ones. Before you place your next trade, watch the next video where we explain staking strategies and annual percentage yield risks. Passive yield can quietly erase your gains if you do not understand the trade-offs. Click the video on the screen now. Thanks for watching. Trade safe. I'll see you in the next video.